A year ago, I sat in this exact chair and told you that 2025 was going to be the year of the great unlocking. We all looked at the charts, we looked at the Fed signals, and the consensus was clear. We thought lower interest rates would finally flood the market with inventory. Buyers would rush back in, and we would see a return of the frenzy we remember from the years past. We were half right. And then tariffs happened. Welcome to your official 2025 year-end review and your strategic 2026 market forecast for Silicon Valley. If you're watching this, you probably already know that the headlines don't tell the full story. Today, we aren't just going to look at the surface level numbers. We're going to dig deep into the psychology of this market. We're going to grade my predictions from last year, wins and losses alike, because accountability matters. And then, I'm going to map out exactly where Santa Clara and San Mateo counties are heading in 2026. If you just look at the high-level data, you might think 2025 was a boring year. The numbers look deceivingly flat. The median price in our area ended the year at $1.65 million, a modest increase of just 2.2%. Sales dropped slightly, down 2.1% compared to 2024. On paper, that looks like a market that is asleep. But if you were actually in the trenches trying to buy or sell a home last year, you know it was anything but boring. It was a roller coaster of emotions, policy shocks, and confusing signals. The story of 2025 was defined by one major curveball: uncertainty. We actually started 2025 on a very strong note. If you remember first quarter, January and February were looking fantastic. Interest rates were drifting down, open houses were packed, and we felt that momentum is building. But on April 2nd, everything shifted. When the new trade tariffs were announced by the administration, the psychological impact on Silicon Valley was instant and severe. You have to remember that in the Bay Area, our housing market is inextricably linked to the stock market. We don't just work for paychecks here. We work for equity. When the Nasdaq gets jittery, buyers freeze. The tariff announcements scrambled the economic outlook. Suddenly, the wealth effect that drives our local housing market paused. Tech stocks wobbled, and that down payment money that was sitting in the RSUs shrank overnight. Then came the local headwinds that compounded the national fear. We saw the revived debate around the California wealth tax and the spikes in gas prices due to the refineries and oil pipe closures. These were not just news stories. They hit people's wallets. These headwinds led to one of the most surprising and paradoxical statistics of the year. Inventory actually rose by 6.3%. More homeowners wanted to sell. Usually, when supply goes up, prices go down. But that didn't happen here. Prices didn't decline. They actually grew by 2.2%. How is it possible? How do we have falling sales, rising inventory, and rising prices all at the same time? The answer lies in K-shaped market. If there is one phrase I want you to remember about 2025, it is bifurcation. We essentially saw two completely different housing markets happening at the same time. On the lower leg of K, you had the regular economy. These are the people working in non-tech sectors, entry-level tech workers, or service professionals. They were hammered by the cost of living, high insurance premiums, and gas prices. For them, affordability was impossible. That segment of the market, homes under $1.5 million, including condos and townhomes, froze solid. We saw properties in that price range stuck on the market for 30, 40, sometimes 60 days. But on the upper leg of K, you had the AI economy. The wealth generated by the artificial intelligence boom here in Silicon Valley is real, and it is staggering. We saw senior engineers, executives, and founders cashing out massive equity positions. For these buyers, interest rate didn't matter because they weren't getting mortgages. They were buying $3, $4, and $5 million homes in Palo Alto, Los Altos, and Saratoga, often with all cash, successfully competing against multiple offers. So while the entry-level market dragged us down, the luxury market pulled us up. This is how you get a year where sales drop, but median prices still inch higher. Now, let's get to the part I know you're waiting for: accountability. I believe that if you're going to trust me with your biggest asset, I have to be honest when I'm wrong. I don't trust experts who bury their bad calls. So I pulled up the script from my forecast video from last January. I made 3 big predictions for 2025. Let's grade them. Prediction number 1 was about interest rates. I predicted that rates would finally break through 7% floor and settle in the low 6% range. The reality? Freddie Mac's primary mortgage market survey shows we closed the year at 6.15%. I am taking a win on this one. We nailed the trend. The Fed cut rates as inflation cooled, and we saw that steady decline throughout the year. Prediction number 2 was about home prices. I forecasted modest growth somewhere in the 4 to 6% range. In reality, we only saw 2.2% growth. I am giving myself a miss on this one. I was too optimistic. The trade tariffs coming in April was a black swan event. That single policy announcement sucked the oxygen out of the room during the critical spring buying season. If we hadn't had that economic shock, I truly believe we would have hit that 5% growth number. But the market got scared, and scared money doesn't buy houses. Prediction number 3 was about inventory. I thought the lock-in effect, people keeping their 3% mortgages, would keep inventory at historic lows. The reality? Inventory actually grew by 6.3%. I'm calling this a mixed result. We saw a record number of listings from people leaving the Bay Area entirely. However, we also saw a higher than usual number of delistings. That means sellers listed their homes, didn't get the price they wanted, and then pulled the home off the market. So while active inventory was up by 6.3%, the number of successful sales went down by 2.1%. It was a year of a mismatch between sellers who stubbornly waited for the right offer and picky buyers who pressed for an amazing deal. That was 2025. It was a year of friction, a year of wait and see. If 2025 was the year of uncertainty, I believe 2026 will be the year of stabilization. Here is exactly what I believe is going to happen in Silicon Valley this year. First, let's talk about interest rates. The consensus among major economists is that the volatility is behind us. We expect rates to stabilize between 5.5% and 6%. The rates might even dip into low 5s by the second part of the year. Psychologically, this is huge. You have to understand that 5.5% is the magic number. It is the threshold that makes the math work for move-up buyers who have been stuck in their starter homes. When rates hit 5.5%, the payment shock of trading up becomes manageable, and that is going to unlock a lot of liquidity in the market. Second, the home prices. We are forecasting a modest growth of 3 to 5%. Please hear me on this. We are not predicting a boom. We are not going back to 2021, where homes go for $500,000 over asking price in 2 days. But we're also not crashing. This growth will be fueled by the continued AI hiring boom and a shift in workplace culture. Tech companies are mandating return to office more strictly than ever. That means engineers must live near Cupertino, near Mountain View, and Menlo Park. They can't live in Tahoe anymore. As long as tech is hiring and forcing people back to their desks, our price floor is solid. But there is a wild card. We have to watch Sacramento. If thousands of business owners decide to list their homes at the same time, because they're fed up with the regulatory environment, the price growth could disappear. That is the variable we're watching every single week. So, what do you do with this information? How do you actually win in 2026? If you are a buyer, your strategy for 2026 is to beat the rebound. Right now, in January and February, sellers are tired. We still see leftovers from the slow end of 2025. Many of them have been on the market for 60 days. But if rates hit 5.5%, the competition is going to wake up. The herd is going to come back. If you can buy now, while the headlines are still mixed and people are still worried about tariffs and AI-triggered layoffs, you will get the price that everyone else wishes for. You need to look for homes that have been on the market for 2, 3, or 4 weeks. That is where your deal is. That is where you can negotiate both the price and the terms. Once the spring rush hits, those leverage points will disappear. And if you're a seller, the advice is different. You need to understand the renovation premium. In 2025, we saw a massive spread between turnkey homes and fixer-uppers. Turnkey homes sold instantly. Fixers sat for months and sold at a huge discount. That gap is going to get even wider in 2026. The wealthy buyers in our market are busy professionals. They're working longer hours than ever. They do not want to manage a contractor. They do not want to pull permits. They want to bring their toothbrush, their laptop, and move in. If you spend 50 grand on prep, painting, modern lighting, updated kitchen, bathrooms, and landscaping, you might make $150,000 on the sale. That is a 3 times return on your money. But if you list as is in 2026, your home will be ignored. Buyers will swipe left. Do not be the seller who steps over dollars to pick up pennies. You have to bring a product to the market that looks like it belongs to a magazine, or you will have to price it aggressively low. There is no middle ground. Let's zoom out for a second. 2025 was a tough year to navigate. It was choppy, it was confusing, it tested a lot of people's patience. But I want to remind you of where we live. The Bay Area remains the innovation capital of the world. The AI revolution is not happening in Austin. It isn't happening in Miami. It is happening right here in the Bay Area. The most valuable companies on the planet are headquartered within 10-mile radius of where I'm sitting right now. As long as that remains true, betting against Silicon Valley real estate is a bad idea. We have resilience baked into our soil. The challenges regarding affordability and regulation are real, but the demand to be at the center of the technological universe is stronger. I want to make sure you have the right data to make decisions for your family. Real estate is hyperlocal. What is happening in Palo Alto is different from what is happening in Sunnyvale, which is different from San Mateo. If you want to see the specific data for your zip code, or if you want to run the numbers on what a trade-up looks like with today's rates, let's have a strategy session. No sales pitch, just data. Let's hope for a stable and prosperous 2026. Thank you for trusting me with your real estate journey. Let's make this year a great one.